Are you thinking of starting investing but unsure of the risks? In today's video, I'll be teaching you why investing is not risky and a simple to follow guide on how you can improve the success of your investments, the quality of the businesses that you put your money into, and overall increase the amount of profit that you can make from your investments. What's going on, everyone? Welcome back to the channel where I bring weekly investing and finance related advice. If you're new here, consider subscribing. All the support is greatly appreciated. Now, I will say when it comes to investing, as with anything, there's always a level of risk associated with it, but there's definitely steps that you can take to reduce the level of risk you expose yourself to. And in today's video, that's exactly what I'll be covering. How you can reduce the risk that you take when you make investments and overall improve your odds for success. Having a good understanding of these steps will put you in a position to invest with confidence and make your trip on the stock market as smooth as possible. This is information that I wish I knew when I first started on my investing journey, and it would have helped me out a ton. So you can avoid the mistakes that I made. Here's my top 3 pieces of advice to make investing less risky. So let's jump into it. The first piece of advice that I have is don't invest money that you can't afford to lose. And what I mean by that is the money that you put into the stock market shouldn't be money that you immediately need for day-to-day living. So funds that you would use on paying for your bills, buying groceries, putting gas in your car, these types of things. Because if you're investing money that you need to live, it places you at a lot of risk because the growth of a stock isn't linear. There's always going to be ups and downs along the way. And if losing some of the money that you have invested impairs your quality of life, it'll place you at a lot of risk and overall stress, because if you put money into the stock market, it needs to be funds that you don't immediately need for the next 5 to 10 years into the future. You definitely don't want to be dumping your life savings that you're planning on using to buy a house or put your kids into college. You need to be comfortable to an extent that you are going to lose some of the money that you invest. This will be in the short term most likely if you've picked good companies. There will be ups and downs, and it's something that needs to be accepted. Don't get me wrong, nobody likes losing money. If you're going to invest, losing money can be a part of it. To be a good investor, your money doesn't have to be something that you're dependent on. The money you need to live has to be separate from the money that you invest. My second tip is not investing on hype. Now, I think this can be best related to a pack mentality. When there's a new exciting stock that's quickly rising in price, people will naturally gravitate towards it because they feel there's profit to be made, and if they don't join in on the crowd, they're missing out on profits and gains that their friends and peers are making. People may start favoring this new company even though there's nothing really special about it that merits its rise in share price. So what do? Do you miss out on these potential profits by not joining the crowd, or do you become part of the pack and start putting your money into this new company? Well, my advice would be look into the company first. Understand what you're actually putting your money into. Don't just buy a business because the share price is going up. Buy it because it's a financially strong company with good long-term growth potential, and one that you would be confident in holding on to, not just 6 months or 12 months into the future, but 5 or 10 years ahead of time. If you're buying a company based on hype, it can reduce the quality of your investments because you don't actually understand where your money is going. And the rise in share price might not be matched by any fundamental changes in revenue growth or overall value of the business itself. And this goes back to the idea of reducing risk, because if you don't understand what you've put your money into, you won't have confidence in your investments. And the only reason you have confidence is because the share price went up. So if the share price starts dropping, you'll lose your confidence just as quickly as you've gained it. If you follow this investing method, you'll end up with butterflies in your stomach every time the share price drops a little bit. And this can be a stressful situation. It's a mistake that I've made in the past, so take it from me and avoid doing this. It will leave you financially burned, and it's a problem you don't want to deal with. My third and final piece of advice is having a plan with your investing. So thinking of how long you want to be investing for. You might be someone who's thinking of a 12 to 18 month period, and this is a relatively short time frame, and it would be more advisable to think of a 5-year plus time frame. Now, this is because with a shorter outlook on your investing, you're more susceptible to market ups and downs, and you're at risk with the money that you put in. Because if you're thinking of this time frame, all you can really hope for is a marginal profit, and also just to protect your investment and try not to lose any money. But if you want to compound your investment and grow it over time, then a long-term outlook, that 5+ year range, is much more beneficial. As I said earlier, there's always ups and downs in the market, and no matter what people want to tell you, it's just unpredictable and it's something inevitable that needs to be accepted. Overall, to reduce the risk that you have, you want to combine all of these pieces of advice, because an absolute recipe for disaster is buying a business with money that you need in a company that you don't understand and only being able to hold it for a short-term period. This exposes you to the most risk, the most volatility, and overall the most stress and potential financial loss that you can place on yourself. So you want to do the exact opposite. You want to hold a company that you understand with money that you don't immediately need for a long period of time. And this sets you up the best for odds of success and overall a less stressful time on your investing journey. Remember, if you found the content useful and want to help support the channel, leave a like on the video and click that subscribe button. I hope this has made you feel a bit more confident in reducing the level of risk that you expose yourself to when you're investing. And that wraps it up for the video. If you want to check out any more content, feel free to click the links on screen, and I'll see you guys in the next video.